Okay, so I just want you to look quickly at these two graphs. We have the nationwide HPI, which has came out last week, where we can see that house prices have come down, bounced up, but effectively are flatlining since the beginning of 2023. Now let's compare this to Halifax House Price Index, where we can see house prices have come down, but they've bounced up, but come down again in a bit of a channel. But now there is a very definite uptrend. So we've got quite a difference between the two house price indices. And last week, when I went live and talked about the Halifax HPI and how there is a clear and definite uptrend, there was a lot of people left a lot of comments on the video saying how the HPIs are a load of rubbish and we cannot believe them. Now, I don't think that's the right thing to do, to go with the narrative that it's just a load of rubbish and therefore we can't believe them. I think we must interrogate the data, understand what's going on, and try and draw our own conclusions. So in this video, what I want to do is go into the methodologies that are used to create these house price indices, try and understand what's going on, have a look at what is potentially the reasons why, number one, we're seeing a divergence, number two, why we're seeing on both indices at the moment uptick in house prices, but why Halifax is going up more, which seems at odds with the narrative about what's going on in the housing market. You know, all logic being there, we should be in a downtrend in the housing market. So let's look at some reasons why that might be, rather than just all the data is made up. And at the end, I'm also going to have a quick look at what's gone on with the local or the latest arrears and possessions data, which has also just come out. And I think this is also extremely interesting and paints a very different picture to a lot of the mainstream narrative out there. So first of all, a very good afternoon/evening to everybody. If you're on the live, we are live, so please give me a thumbs up and put something in the comments box if you can see and hear me, because we are live. If you're watching this on the replay, please put your thoughts in as we go along. For those of you who are new to the channel, on these live streams, my aim is to dive into the data that is beneath all the headlines so we can get rid of all the hyperbole and try and understand what's actually going on to make more informed choices and not end up making poor financial choices. Okay, so that's what we're going to do right now. Now, before I do go on as well, I'd like to ask what you are seeing in your areas. What's your sentiment? What are you feeling? Because a lot of people are saying, everything in the area is not selling, or things are selling for massively discounted prices, and therefore the property prices must be going down. But when we look at the HPIs, it does paint a contrarian view to that. So why is that? Stafford's on. How are you doing, Stafford? So I'll be interested to see what is going on in your area, because of course, one of the things I mentioned last time is we have multiple areas. We have microclimates, if you like. I actually call them microscapes when I talk about this with my property cash flow accelerator clients, but we digress. So first thing I'd like to bring everybody's attention to is there is a website on the government, or a web page on the government website, that talks about HPIs, house price indices, and the differences between the various indices. Now, I know there'll be those straight away that goes on the government website. It's all going to be a load of BS, but let's go through it and see how these are actually calculated. Now, the first thing that I want to talk about is we have different weightings, okay, which are revised on an annual or a semi-annual, so biannual basis by the different indices. Now, what does this mean? So just like when we talk about the elements of the CPI basket, and we talk about the different weightings and how weightings can be skewed in that to kind of, you know, come up with a narrative that fits the picture, and we've been talking about that quite a lot for the last few months, the HPIs have the same. So before we talk about the weightings, let's just run you through what if I can find the actual thing. Sorry, I've gone the wrong direction. No, I went the right direction. That was the explanation, okay, of what the hedonic regression method is. Sorry, so first, I'd recommend you read this, pause on the replay, read it. Effectively, the hedonic regression model that is used in the UK HPI, that is used in the Nationwide HPI and the Halifax HPI, which is different to the Rightmove HPI, is effectively each property is bundled into a set of features or characteristics. And all of these characteristics contribute to the price sort of model that this comes up with, just like a CPI basket has got a bunch of characteristics into it. So for example, we've got presence of garden, number of bedrooms, location of the property, but all of these things are not priced in isolation, it's bundled together. Okay, so the regression model is then used to estimate the value of these features in a particular period and then puts together its model. Now, what is interesting when I look through this is the fact, and I'm going to have to go up again, is the fact that each index changes its weightings, and the Nationwide changes it on a 2-year basis. The Halifax changes it on an annual basis. Now, I couldn't find anywhere exactly what dates they actually changed the weightings, but when they change the weightings, effectively the hedonic regression model is kind of comparing to the previous set of weight, or the previous year's worth of data, or the previous period's worth of data, to compare against the type of property transactions that have been happening. So if we look at these two, right, there's clear difference here between the two models. Is it possible, as a hypothetical, that there has been a change in the weightings of the Halifax, bearing in mind that the Halifax updates twice as regularly as the Nationwide, and that the Halifax is now comparing that sort of basket of characteristics against what happens in the previous period? And if we have, and I'm just going to come off full screen here, if we have super low transaction volumes, if there's been a very definite shift in demographic, and we talked last year about the shift of people selling larger homes and sort of downsizing or geographically relocating to smaller homes for affordability, has that put a skew in the weightings? And now we're assessing, or the Halifax is assessing its hedonic regression model against what is now an updated weighted set based on what happened last year, and that's putting a skew in the figures. Is that something that is happening? So that is the first sort of hypotheses to put in there. Okay, so I'll be interested to see what you think about that. The next thing is to talk about the average price. Okay, so the way, again, that the hedonic regression models use is they use something called a geometric mean. So we've got 3 different averages we can use. Okay, we have the arithmetic mean, which is the very simple way of finding an average. This is what something like Rightmove would use, for example. So it takes all of the property data, adds it all together, and divides it by the numbers. So on this example, if you've got 5 properties that are sold, 4 at 100K and one's at $1 million, okay, the arithmetic mean would be 280,000, which clearly is massively skewed towards the upside, which is why when we talk about the Rightmove HPI being done on listing price, this is how it's working. So if we've got a lot of high value properties going up, this is definitely going to skew the listing price or the arithmetic mean that Rightmove would show. The geometric mean, okay, is timesing them all together and then dividing by the root of the number of properties that's in that mix. So using the same data there for sales at 100K and one sale at $1 million, the geometric mean would be 158,000. So actually, the fact you've got higher value properties are going to skew it to the upside if you've got more higher value transactions going on, but not nearly as much as the arithmetic mean. And then we've got the median, which is simply the middle number after sorting the data. So the median of that data would be 100,000. So you can see for the same bunch of property sales in this instance, I know this is vastly more complex, we've got an arithmetic mean of 280 grand, a geometric mean of 158 grand, and a median of 100,000. So a massive, massive range. However, that being said, it does follow that even when using a geometric mean, if we have lots of higher value properties selling and not lower value properties selling, that will adjust or it will skew the data up. So in any data set, when we have a smaller data set, bigger anomalies in that data set will skew it more. So if we're working on, let's just pick a figure out, half the transaction volume that we would usually use for calculating these difference in property prices are going to skew it more than if we had more transactions. So that is another reason that we could be seeing the data skewed. So that's reason number 2. Reason number 3 is the actual adjustment methodology itself. Okay, so we've talked about how the hedonic regression method works, and if we can understand there are a basket of characteristics, if you like, those characteristics are different between indices. So if we look at the Nationwide and we look at the Halifax, Nationwide looks at location, property type, number of bedrooms, acorn area classification, and euro property, so much fewer variables. Halifax has more variables in, which is location, property type, number of bedrooms, floor area, and this is the big one. We spoke about this last year. I'm going to go over this again. Area classification, which is Halifax's own model, new or old property. Now, the floor area, I think, is an interesting one because I would imagine it. So when I look at property as an investor, one of the key metrics I look at is price per square foot. Because when we're comparing properties, clearly comparing an actual price is fairly ridiculous. If you're comparing, a 2-bed terrace with a 4-bed detached, of course, one's going to be more expensive than the other. What you want to do is take let's rephrase that. Let's say a 2-bed detached that's 600 square foot versus a 2-bed detached that's 1,200 square foot, okay? Of course, the price is going to be very different, even though it's got the same characteristics. What is a more representative example of what a property is worth is the price per square foot method, which is taking the value, dividing it by the amount of square foot. And if the Halifax has a variable of floor area, I can bet your bottom dollar that there is something that's in that algorithm that is looking at the price per square foot. Now, as properties get smaller, generally, not all the time, but generally, smaller properties are going to have a higher price per square foot. And as properties get bigger, they effectively get more airy, right? There's more space in them, less price per square foot. So we talked last year about the fact if everybody's selling more expensive properties going into these smaller properties, is that skewing it by effectively pushing up an average price per square foot in an area. And again, smaller transaction volume, smaller data set means that it's going to skew more easily. So number 3, in terms of why these are different, is it floor area. Now, number 4, actually, and another difference, is Halifax also contains buy-to-let data. Nationwide doesn't. Now, this is interesting because I think, conversely, I would expect anything that includes buy-to-let data to probably be negatively affected compared to residential. Because when we look at the arrears and the possessions in a little bit, we've been talking for a while how the buy-to-let sector is in a bit of trouble right now. And we'll sort of continue that narrative. But there's that set of data in as well. Now, I don't know exactly how all of these numbers get crunched into the models. But it gives us some hypotheses we can work with. So number 1, more expensive houses are selling. That will skew it up. So could that be one of the reasons? A price per square foot skew, is that skewing? Now, an interesting thing that a few people said in their local areas, and this is anecdotal, but I think anecdotal is quite, can often be quite accurate. The only houses that are selling are the good ones. So good houses priced appropriately are selling. All the rest of the houses that are either priced inappropriately or not the best are just sitting there on the market. And of course, at the moment, we are still in historically low transaction volumes, right? Even though it is thawing a little bit, when I say thawing a little bit, I mean the trend is going, the transaction volume is going up, but it's still very low by historical standards. If we can still say that we're in a bit of a freeze, but only the good stuff is selling, then that's going to skew it. And then the 4th thing is, does the weighting affect it? So those are the 4 things I wanted to look at. But even when we bundle all of that sort of stuff together and zoom out, right, I find it impossible to come up with a narrative that we're in full meltdown, that we are, already 10, 20% down over the last 6 months. Like, some people think we will be. When we look at the ONS data, it's also not reflecting the big drops. And it's easy to go, oh, look, all the data's laggy, right? And actually we could be 10, 15, 20% down from where ONS is saying right now. We could be. But nothing in the other data sets are demonstrating that. So yes, I think there are very plausible reasons why we're seeing, a leveling, why we're seeing on the Halifax, that increase in the HPI, and they could well be skewed. In fact, I would say almost categorically they are skewed due to the amount of data transactions and all the things we've talked about. But the conclusion that comes to that is we're kind of still in paralysis with not a lot going on and probably only the good stuff selling, which is a very different discussion point to being in market meltdown with a flooded market of forced sellers and everybody taking massive haircuts on their properties. So when I talk about right now, I feel there is a perception, there is a feeling in the water, especially as we come into spring now. We'll be interested to see what happens with the spring bounce, that affordability is increasing. Again, when I say affordability is increasing, I do not mean everybody's getting really rich. I mean the lack of inaffordability is tapering down, right? Utilities are better price. Mortgage rates are coming down for people who are going to new mortgage rates. Yes, I know there's loads of people still coming off fixed onto much higher, but new mortgage rates, are come down a lot over the last few months. So those things will feed into confidence. Those things will feed into affordability as pay goes up. And I feel we're seeing a frozen market slightly thawing, but a sort of little boost of optimism, which is not leading to lots of forced sellers. Doesn't mean that won't happen in the future. I think it's really important I say that. We could be 3-6 months' time in full-on recession with loads of forced sellers. However, I'm not going to talk about the economy today, but there definitely seems to be the narrative that we've probably gone into technical recession with a very slight Q4 2023. We'll have to wait for the data that comes out this week, I think it is. But again, the feeling in the water is there's going to be back to some growth this year. Not anything exciting, right? Basically, pretty much flatline, which whether it's flatline plus 0.5%, negative 0.5% doesn't really matter. It's kind of going nowhere. But that's where I feel we are right now. And I just wanted to do a little bit of different research or statistical analysis of my own with nothing scientific at all. I'm going to show you this just to see what is going on, because we talk about the three big crisis triggers being affordability, being unemployment, and negative equity. So I wanted to get an idea of what's going on with negative equity. So this is one of the prop tech tools I use called Property Filter. If anybody wants to have a play with this, there is a link in the description to the video where you can get a trial. It's got 50% off on your first month as well when you use my link, so feel free to do that. But I did a search in my investment area, which is Chester and sort of surrounding areas, to properties that are in negative equity. And when I do the search, you can see the area I've created is basically a 10-mile radius. There's 97 properties listed in that area that are on the market right now that are being sold at a low, or being advertised at a lower price than they were purchased for last time round. Now I've gone into Rightmove, and I've also done a search with a 10-mile radius around Chester. And by the way, I know this is like super unscientific and unstatistical. I just want to create an example here to see how many properties are actually on the market in total on Rightmove alone. So on Rightmove alone, 10 miles from Chester, we've got 4,513 properties on the market. And Property Filter is or estimating we've got 97, which is in negative equity, which by the way is about 2%. So that's showing that 2% of properties on the market right now are in negative equity. To me, that is not a massive flood of motivated sellers flogging their properties for more than they bought them. So we'll keep an eye on those sort of stats. So let's just remember that 10 miles from Chester, about 2%, according to these filters. So that's something that's interesting. Before I'm going to keep it quick today, by the way, team, because it's single daddy daycare. It's half term. I've got my kids upstairs. And I need to go and make some dinner for them soon. So I'm going to talk through the arrears and possessions data. Before I do, I would like to ask for your help to support the channel, and I'm going to hand over to my past self to tell you how you can do that. Regulars, you'll know that I'm fascinated by data, and when I look at the channel stats, I can see that just under 65% of people who watch my videos aren't actually subscribed to the channel. Now, I do know this stat is actually way above the average for YouTube and shows the power of the community that we're building here. But I want to do better, and I'd like to make a deal with you. I've got a vision to empower as many people as possible on this planet to take ownership of their futures using income-producing assets to reclaim your time, freedom, and choice. And if you can just hit that subscribe button, I'll work tirelessly to grow this channel, make it better and better for you so we can fulfill that vision together. I cannot tell you how much it helps. As the channel gets bigger, I can put more resources behind it, improve the production, the content, and ultimately the value that I give to you. So if you could do me that small favor and hit that subscribe button now, as well as the like button on this video, it would mean so much to me as we continue to grow this community together. It's the only favor I'll ever ask you. Thank you, and let's get back to the episode. Okay, please help me hit subscribe right now and like and get YouTube getting some more reach to the video. That'd be fantastic if you like statistical analysis and understanding what's going on and chewing through the thought processes. So just before we go to arrears and possessions data, I can see Mark says lots of relisted properties in South Yorkshire, slight reductions, many are delisted this year, so suggests a lot fall through. What will be interesting actually is the filter I just ran on Property Filter there, looking at negative equity. We can also do the same, looking at things which have got price reductions, all that sort of stuff. So I might just run the same in my area, see as a percentage the amount of price reduction. By the way, I think this is why we have to be careful with data, because just because something has a price reduction does not mean that property prices are falling. My overall thoughts on the market is after the boom we had post-COVID, so into 2022, going into 2023, people were selling their properties at way inflated prices or listing their properties at way inflated prices. So price reductions could be taking something down from massively inflated, still to inflated, to actually where it should be, and to then we start seeing actual property falls and negative equity and all that sort of stuff. I maintain team, and I've always said this. I've always said, looking at what's going on, we'll have slight nominal falls. I reckoned until sort of Q3 this year. That's kind of when I said we probably might trough in terms of nominal. Real falls, probably for another couple of years after that at least. The only thing that's going to tip that over the edge is probably either a deep recession or a third-party event, a black swan event that takes us into a deep recession and creates the forced sellers. And at the moment, we don't have that. We'll see what goes on in the Middle East. So last thing we'll talk about is arrears and possessions data. And I'm just going to zoom in before I go over to it. This is our quarterly little recap of the data. If those of you, if you've not seen this before, we're going to break this down into homeowner and buy-to-let. This one at the top here is total. So it is with no surprise that we are seeing increases in the number of mortgages in arrears. Look, we've gone from 0.1% interest rate to 5.25% in 18 months, right? It's literally gone from. That is going to put people in pressure, right, under pressure. We also need to acknowledge or understand that most banks have signed up to the forbearance charter, which means they will not start repossession proceedings for 12 months longer than they could do. So this is another factor. Something that I want to look at is the rate of change, okay? Because for me, if we see things accelerating, it means I think it's a worsening picture. If we see things flattening off, it's an improving picture. So let's start with the homeowner mortgages within arrears bands. And if I zoom in on this even more, just so we can see it, okay, this teal is the one we're really interested in, which are people that are coming into the 2.5% to 5% band. Now, it starts at 2.5%. And what's important to say is that if you have a 75% loan to value mortgage you've just taken out, to get into 2.5% of arrears, you'd have to have missed 5.5 months, right? So there's going to be a lot of people who have missed 1, 2, 3 months of payments and are still not showing up in this data, which is why it's kind of so laggy. I don't particularly care much about anything above, below the teal or above the teal, because it figures that if people are going into the teal band, right, if they carry on not paying, the other bands are going to go up as well. So it's those people who are entering that top of funnel, if you like. Although I suppose it is interesting to see if people, do actually clear their arrears off or get repossessed, that sort of stuff. Anyway, so we were seeing sort of, an acceleration of this. But if we look at the graph, okay, in this quarter, which is here to here, we're actually seeing a very slight reduction in the rate of increase. So we've seen an increase in the number of mortgages, but we are seeing a slight reduction in the rate of increase, which I think is interesting, because if things were getting worse, I would expect this to be accelerating, right? From here, you can see each month that line's got steeper, but it's sort of dipped a little bit. So that gives us only a 5%, I say only, it's still 5% quarter on quarter increase of people going into the 2.5 to 5% balance. Year on year is 36%. These are still historically low or fairly low averages by historical standards, by the way, just to put that into context. Now, let's look at the buy-to-let. The buy-to-let, we were seeing that hockey stick come in. But again, we've seen a flattening of the rate of change. So again, it's gone up, but a flatten. So we've seen 8% quarter on quarter, year on year, 165%. We are seeing, this filter into buy-to-let quite a lot. Look at that, 5 to 7.5% of balance, 190% increase. So as I've been saying, pretty much for 9 months now, the vanilla traditional buy-to-let sector is the one that's really struggling here. And that's because there's a perfect storm of factors at play with interest rates going up, rent reform or tenant reform bill, and with Section 24 coming in, which of course is the tax issue. So landlords are being absolutely clobbered if they are highly leveraged. And the saying, who's been swimming naked when the tide goes out. So this is what's been happening in the buy-to-let sector. A lot of people struggling there. Because they were basically operating, very low margin property investments, with just about washing their faces. And now that all these other things have happened, they're just not functioning anymore. So when we are looking at property investments, we have to be looking at high cash flowing property investments, which is why I talk about the property unicorns all the time. So I think that's interesting. That rate of change has flattened off with people going into this band. I don't know if that's pertinent. It's not a trend. We're still going up as we would expect to go up. But let's just keep an eye on that and see if that starts leveling off. I'd love to know your thoughts on that one. Cool. That's all I've got for you today. It was a quick whistle-stop tour of the HPIs before we get some GDP data, which I think is out this week. And it won't be long, of course, until inflation data comes out again. So let's see what we've got in terms of comments. We've got Darren from Suffolk. Hey, Darren, how you doing? Greater London area, as you allude, only the very tidy homes selling, but the tatty boomers houses not selling. Stale market. So we've got 3 markets, don't we? We have stale market, we have buyer's market, we have seller's market. I would suggest we are in a stale to a buyer's market, i.e., for those people who do want to sell, there are some great deals out there. As always, I still see it. Baby boomer sales who've got a lot of equity in their home and therefore don't mind shaving a bit off if they want a quick sale, and they're still going to make 500 to 1,000% return on whatever they bought the property for 20, 30, 40 years ago. They're fine. Or investors, institutions, companies, pension funds, boomer investors who are cashing in, who want to get out of buy-to-let because it's a struggling market, are selling for some very good deals right now. A lot of residential people, if you're not a for seller, why would you sell? Why would you sell and get rid of that potentially 2% mortgage that might be valid for another 2-3 years if you don't need to sell, right? So a lot of people are sitting on their hands. And I think this is important because I think people are sitting in their hands. We're still in that space. We still don't have, a deluge of for sellers. Therefore, the property market is not in meltdown. And I just want to be realistic here. I want to look at the trends. I've always said that on this channel, my point is not to be a doom scroll target, right? That it's just like, everything's going under. I want to look at the trends and be objective with what's going on. This is what I feel. So there we go. We've got Stafford. Let me just put yours on Stafford. Spoke to an agent friend the other day, asked how things were. He declined to be negative, but winced when asked. Near Chippenham, keep an eye on prices. I think without a doubt, the South, and Chippenham is obviously South. The South is real term or nominal real term actually declining in house prices. So this is the other thing to talk about with when we look at our microscapes or our microeconomies. All these figures we look at on the HPIs are macro UK. We need to understand those little, individual areas, south, southeast, southwest, I think are, in actual terms dropping. That's true. Not the picture in the entire of the UK. There we go. Any more for any more team? Let me know in the comments about your thoughts on arrears and possessions, because it surprised me when I saw that. I'm going to be honest. And again, I think it adds that narrative of things not being quite as bad as some people like to think about. One other thing I'll show you on that before I end is the actual amount of possessions, and we can still see them coming down because this will be the 12-month forbearance charter coming in. So the ones that are being repossessed are probably already in the system. Minus 14% quarter on quarter for homeowners, but buy-to-lets are not in that same bracket as forbearance. So buy-to-lets are being repossessed. Not a huge amount though. So we want to see that teal going down, blue is kind of pretty much getting a little bit bigger, which I think is interesting. All right, team. As always, it's been a pleasure. I will report back when we have some GDP data. Have a great week, and I will see you very soon.